Hello value investors, thank you for joining me. Today I want to talk about Netflix. Netflix is one of my favorite stocks. So I'm going to tell you why I believe Netflix is overvalued. Before we get started, don't forget to subscribe to get my next value installment. Also, come over to my marketplace and do a free trial. Deep value returns on CKN Alpha. I'll tell you which stocks I own and why, with balanced arguments for the stocks I own. So let's get started. So today I want to talk about revenue growth rates, subscriber numbers for Netflix, its amortization profile, and free cash flow margins, before wrapping up and talking about its valuation and competitors. So here's the thing. For Q2, Netflix reported a 25% revenue growth rate. Looking ahead to Q3, it was reporting on a guidance 21% revenue growth rate. And here's the thing, I look back here, and at this point in time in Q1, when Netflix reported 22%, I thought that was it. I thought that Netflix was starting to fizzle out because it had come away from 2018 at 35% growth rates to come down to Q1 2019 when it's 22%. But after that quarter, it still ramped right back up to 30%, 31% indeed, revenue growth rates. So I don't think that this is a kind of a down and out scenario, but it's very, very interesting to see how things unfold from here. The next thing that is worthwhile discussing is Netflix subscriber numbers. So in the United States and Canada, that market is pretty much saturating. And looking elsewhere in the world, the numbers can come in quite strongly, but they have lower average revenue per user numbers. So you have the pricing power is lower outside the United States and Canada, but they have strong numbers coming in. So that really kind of muddles up the picture, because the number of subscribers coming from international is really, really high. And it overshadows what's happening in the United States and Canada. Even though this quarter that didn't really take place, looking ahead, I think that's a reasonable estimate that the international numbers will be stronger than the United States and Canada numbers. But also, you have to remember that the international subscriber not only carries a lower average revenue per user number, but it also has a lower profile number. So that's a very, very interesting dynamic. Moving on, this is one that's very, very interesting. The amortization issue. So for Q2, Netflix states that our content's cash spend was 2.6 billion, which pretty much matches the non-cash amortization of contents. Now, of course, bearish like investors like myself will say that's a quarter when they were really spending as little as possible because they weren't able to shoot a lot of content. So if this is a steady state, I think myself, wow, that's really, really a lot of, they call it cash investment, I call it cash burn. But that's really, really something that's quite significant. On the other hand, Netflix is saying that this Q2, on a steady state, cash flow had free cash flow margins of 15%. So they're saying this is what we could do once we reach a maturity. We're nowhere near that maturity level yet. The runway is still quite long. I question that somewhat. I think that it's the start of the end. But I don't want to get ahead of myself. As an investor, I think that this is the most important thing to think about. As the amount of revenue growth rate is starting to kind of taper off, as we've already seen, the multiples that investors are paying for Netflix continues to soar. Now, what is the right multiple? I have absolutely no idea. And it keeps on getting very complicated, this picture, because the amount of money that the government is printing off is really pushing up this multiple, and all assets are now trading very, very high. I could make the bullish argument that once somebody's on Netflix, they're likely to stay on Netflix for some time, so you have a very stable base low churn rate. So if you look, it's not a SaaS business, obviously, but if you look at the rest of the SaaS world, you're looking at 20-25 times sales. So in comparison, something that is a leader in a space and with the subscriber not likely to churn out significantly, because if it were going to churn out, you already have seen this taking place now as the economy just basically fell through in Q2. So you could make the argument this could still increase further. I'm a value investor. For me, this makes absolutely no sense. But objectively, you have to see the two sides of the argument. The only way that you as an investor can improve is if you can see the two sides of the argument. Nothing is black and white, especially in investing. So it's very, very important to keep that in mind. What I will say is that right now in Q2, Netflix had the opportunity to be a leader in a space. There was not a lot of sports. Disney didn't really have enough of content to really new jazzy content to put on its platform. So you had something like Apple that is really kind of just starting to wake up. Amazon does its stuff on its side, but the competition was dormant. So I think that they had basically the perfect storm coming their way. But you could also make the argument that the valuation is not as punchy as it could be. So just to summarize, we discussed in this video revenue growth rates, and we talked about the subscriber number, the amortization profile and free cash flow margins. We also discussed in length about its valuation and the competition to a certain extent. So if I think that you found this video useful, why don't you check out my marketplace, Deep Value Returns, on Seeking Alpha. Do a totally free trial there. Find out which stocks I own and why. And as always, don't forget to subscribe. See you next time. Bye.